if those loans would result in a smaller profit than it would otherwise make, but it is not required to lose money. Now that's a trick, to tell a private institution to subsidize something, not make as much money as they might, but not lose money. But again, that requirement went back to 1970. I did not know this until I started working on this issue, because certainly housing was not my specialty. There actually was a subprime mortgage market, as far back as at least 1998. Subprime mortgages are a particular way of fostering affordable housing. And they're called subprime because the borrower doesn't meet some of the normal criteria for getting a mortgage. Usually has little or nothing to put down, and doesn't meet the income tests. Because in 1998 there was a first failure of the subprime mortgage business, just as it was getting started. It got caught up in 1998. There was first the Asian financial crisis, then the Russian crisis, then the collapse of a company called LTCM, Long-Term Capital Management. Subprime mortgages took off beginning in 2001. They began to have explosive growth. And I'll give you an idea. In 2001, total outstanding mortgage obligations were $2.2 trillion. I can't tell you how many times I'm talking about trillions in this lately, and I'll say billion because billion is the biggest number I've dealt with before. 2.2 trillion. In that 2.2 trillion, only 190 billion were subprime mortgages. And that was 8.6% of total outstandings in 2001. By 2006, total mortgage obligations were almost 3 trillion, and the subprime component was now 600 billion, or 20%. So there was a very, very rapid growth of subprime mortgages in that 5-year period. Now, something else was also going on that you've probably heard about, and it's called securitization. And securitization is basically occurs in the following way. A bank makes a loan. It could be a mortgage, it could be a car loan, it could be a business loan, it could be a credit card loan. And some entity, it could be the bank that makes the loan, but more often than not, a third party to whom the bank sells the loan, puts a bunch of like-minded loans together: car loans, credit card loans, business loans, I think personal loans too, and mortgages. And they package these loans together into a security and they sell it on the market. That's securitization. Securitization also grew very rapidly. In 2001, 50% of mortgages were securitized. And in 2006, 80% were securitized. So phenomenal growth of securitization and phenomenal growth of subprime mortgages. Now, subprime mortgages, as it turns out, don't work at all unless they're securitized. That's part of the whole economics of how they work. Again, a perhaps laudable goal. I know this is a libertarian club, so a lot of people say it wasn't a laudable goal at all, but I'm just saying it was a good intentioned goal. But it's been around since the 30s, and in its modern form since certainly 1970, and most of the rules in place were in place by the 1990s. But it was a burden until financial engineers, Wall Street, figured out actually how to make money on this. Then it grew like topsy. You know, bankers don't make loans out of the goodness of their heart. They make it to make money. And once they can make money on something, all stops are out. Okay, so as I said, I'm going to talk more later about monetary policy, but I wanted to get that out. And obviously, there's many aspects to this we can talk more about. Okay, the next issue is, and this came out mostly of the election, where you hardly ever get an accurate portrayal of anything if it gets caught up in electoral politics. But constantly it was said this was all the product of deregulation. And I was amazed that McCain never shot back and said, what deregulation? There was absolutely no deregulation of any kind of the financial services industry in the whole period of the Bush administration. It never occurred. The last act that could be called financial deregulation, a statute, is called the Graham-Bliley-Leach Act, Financial Modernization Act. Graham-Bliley-Leach, it's hard to say. And it was the Financial Modernization Act of 1999, passed by Republican Congress, but signed into law by Clinton very readily, because the Clinton administration was very pro modernization and deregulation of the financial services industry. They took the lead on this. They were very supportive. I was working at that point, well, most of the period. I was actually gone from Citibank by the time the bill passed and was signed, but I worked for Citibank the whole time this was going on. So, and our relationships with the Clinton administration was great. Secretary of Treasury Rubin, his deputy, Undersecretary Hawk, who used to be General Counsel for the Federal Reserve System, they were involved in this. It's called Graham-Bliley-Leach because Senator Phil Graham was the chairman of the Banking Committee. Congressman Bliley was the chairman of the House Commerce Committee, and Jim Leach was the chairman of the House Banking Committee. I'm just telling you this because whenever a bill is passed, it's almost always named after the chairman of the committee out of which it came. Why were there 3 committees? Because the House, until very recently, was really a screwed up place and would have, I'm not saying it's not screwed up anymore, but it's not screwed up in the following dimension. It always had situations where there'd be multiple jurisdictions over an issue. And in this era, the Commerce Committee and the Banking Committee had overlapping jurisdictions over financial services. Senate never had that. One committee has jurisdiction. For instance, in this whole mix, there's something called the Commodity Futures Trading Corporation, which regulates commodity exchanges and futures exchanges, as the name implies. Does anybody want to guess what committee in the House of Representatives has jurisdiction that originates all bills relating to this issue? What committee would you think would have jurisdiction over commodities and futures? These are very sophisticated contracts.
Agriculture?
You're right, the Agriculture Committee. Why? Commodities used to just be agriculture, or they were the most important. So, okay, so that the regulation of financial services industry is very complex. There are a lot of people who have a hand in it, both in the Congress and in the agencies that regulate. Contrary to what you may have heard of, financial services was not deregulated in the last 8 years. And every part of financial services is heavily regulated, with, depending on your viewpoint, maybe one possible exception. It is, in my opinion, the second most heavily regulated industry in the United States. What's your candidate for the first most heavily regulated? Aviation? No,
Healthcare?
no, because you don't get into, well, that's interesting. Safety, maybe, yeah.
Healthcare?
Yeah, I'd say healthcare, because you get into pricing, and you don't get into pricing anymore in aviation. That's why I was reluctant to say aviation. I think healthcare is more regulated, but people in financial-wise services might make a contrary argument. Yeah.
What did Reagan do in terms of deregulation? Wasn't that
Reagan?
Ronald Reagan, where the banking, the insurance industries were all separate? He was the one that actually.
No, the big thing that came under Reagan was, while he was president, and while he was president, there was the deregulation of interest rates paid on bank deposits. And that was the big deregulatory move that occurred under Reagan. The regulatory structure otherwise was unchanged under Reagan. Now he had, and I'll get to this, there was a big crisis in the savings and loan industries that occurred under Reagan, but that was building before Reagan. As I said, the last statutory deregulation was in 1999. Let me tell you what it did, because it's interesting. President Clinton was asked, he was interviewed, he said, well, isn't it this thing you signed that caused all this? And he said, I don't know